Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to Live Squawk's Market Talk. With Q2 earnings season upon us, we thought it a good idea to bring in an expert to help take us through what to watch for. Friday is the unofficial start to the earnings season, with investment banks set to report numbers for Q1. We'll hear from the likes of JP Morgan, BNY Mellon, and Morgan Stanley, amongst others, on Friday, and the rest over the course of the following week. I'm joined today by regular expert Christine Short, Head of Research, Global Corporate Events at Wall Street Horizon, a TMX company. And we'll bring Christine in a second. But again, just some housework here. Before we go any further, a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that, I'd like to say hello to Christine. Hello.
Hi, Harry. Nice to be here. Thanks for having me.
Thank you for coming on again. I guess there's lots to unpack ahead of the bank numbers at the end of the week, let alone what we're seeing globally from the trade dispute we're ongoing at the moment, what the US seems to have with everyone else in the world. So I don't know, where do we start with today's sort of episode? What do you see from let's go with the earnings season itself and the regular stuff. What are we expecting? Everything else, and then we can look at the impact from the trade war.
Yeah, right. Because that's probably gonna materially change what some of these companies say. But overall, the earnings season, which of course is backwards looking, right? We're looking at Q1 2025 earnings, and so far the expectations are quite good. We're looking for the S&P 500. Earnings growth to come in at about 7%. That would be the seventh straight quarter of year-over-year earnings growth, but it's quite a bit lower than what we saw in Q4. Q4 we posted about 18% growth, so a bit of a decline from there. And then if you look at what we were expecting at the beginning of the year for Q1 earnings, that was closer to 12%. So certainly analysts coming in, ratcheting down estimates, and they're doing so because companies are guiding lower, right? So I think about 107 S&P 500 companies have issued quarterly guidance. Of those, 68 are negative. That's higher than what we've seen over the last 5-year average and 10-year average. So more negative guidance than typical. Of course, that filters through to what Wall Street analysts are saying. They're ratcheting down. We know corporations are a little conservative when they give guidance. They want to underpromise and overdeliver. But I think it's worth noting, that corporations' guidance is coming down. Analysts are pulling back on estimates. And then just like kind of an early look, I know you said we sort of unofficially kick things off with banks on Friday, but there's been 19 S&P 500 companies that have reported thus far. And of those, only 12 have beat estimates. So that gives you a beat rate of 58%. You follow this stuff. It's like usually 80% of companies are beating. And yes, this is like a really small sample size, but it's a good smattering of companies from different sectors. You've got FedEx and UPS and ConAgra, some of the consumer staples names. You've got Nike, some of the consumer discretionary industrials. So, they're kind of seen as the bellwethers. Not to say how these 19 go, the rest will go. But I think it's been an interesting look that not only are the backward numbers looking, not coming in so great, but it's really the forward-looking that we always care about the guidance more than anything, but especially this season where we already know corporations have said, we just don't know how to factor in trade policy. We don't know what the trade policy is or what it's going to be or where it's going to land, what's the scope, what's the timing. And so I think guidance is going to get pretty murky this earnings season as corporations, IR teams might be working up to the last minute to kind of either figure out what the guidance is or whether they're going to give any at all.
Yeah, it's a scramble basically at this point, I think, because like you say, this changes on a daily basis. The situation currently is changing on a daily basis, and we'll probably get into the US economy a bit more and the North America situation. But I mean, you're hearing warnings from banks already, and from Wall Street rather. Goldman Sachs strategists said the current event-driven bear market could easily morph into a much longer-lasting cyclical one. Yet UBS's chief strategists say that tariffs could hammer consumer demand, resulting in zero earnings growth for US companies this year. So, and there are more, and we can go through more. But I guess to your point is that we can't really hold too much store in the current forward guidance as it stands, because again, it's so fluid at the moment, and things could change very rapidly.
That's absolutely right. And like you said, we've started to hear from CEOs. We were kind of waiting for that. We wanted to hear specifically, look, the banks are up first. We get the shareholder letter from Jamie Dimon yesterday saying the faster these trade disputes are resolved, the better, warning tariffs will slow growth, everything we kind of knew, right? He wasn't willing to go as far to say whether he thought, a recession was probable. Larry Fink, BlackRock's head, said that he's, in talks that he's had, there's many CEOs that think a recession's already here. So, the difference this quarter versus last, we saw the topic of tariffs come up very frequently last quarter. I think the most mention of tariffs for S&P 500 companies in their earnings calls in the last, 10 years or more. But the instances of the, mention of recession was very little. So maybe 260 companies mentioned tariffs, but only 12 mentioned recession. And I think analysts are going to be asking more of that recession question. And you mentioned some of these big banks, that are increasing their probability of recession. Deutsche, Goldman, so everyone's coming in and kind of rejiggering their calculations. And as this continues on, the probability of recession, according to economists at these banks, gets higher. So, yeah, that's why these earnings calls are, so important. Some companies are vague. I like that it kicks off with the banks because they really don't mince words. Jamie Dimon, he really just kind of usually lays it out like it is. Citigroup CEO Jane Fraser, they kind of set the stage, right? Because they're telling you about the economy, they're telling you about what they're seeing. They're giving you a peek into the consumer with credit cards, lending. And so, there's some tailwinds for banks heading into the season. You've got volatile markets are great for trading revenue, right? Investors want to buy low, sell high. And so we're certainly going to see trading volume help the banks. Net interest income, interest rates are still stubbornly high, that they'll continue to see higher net interest income. Even some mortgage lending. I mean, some of the housing data that came in the US in Q1 showed a little bit of a reprieve. Mortgage rates haven't moved much, but it's inventory loosened up a little, and there's a lot of pent-up demand here. So, you might see that help the likes of Wells Fargo and some of the other lenders. On the kind of headwind side is investment banking. The underwriting has been suppressed. We haven't seen the volume of IPOs and M&A that we were all expecting heading into the new year as the Fed started to cut rates. The story was, deal making will return, right? It'll be cheaper to borrow money. But in fact, we've actually seen companies that were expected to make their public debut are putting that on pause. Like Klarna, was rumored to be preparing for their IPO. They seem to have put that on pause. Chime, you had StubHub, so a handful of names choosing not to do so, and
understandably, yes.
Understandably, I mean, you can't. It's so uncertain now. Not only is it expensive and hard to borrow money, but now you're in an environment where not so many of the recent IPOs have done very well. And there's so much uncertainty. It's like, why would we debut now? If anything, we're going to raise private capital.
But I guess they knew this. They knew President Trump was about to regain office. When I think the Klarna news was, they announced that either early this year or back end of last year. So, I guess what's taken them by surprise is the veracity of what we've seen in terms of the new administration's vigor to sort of address certain issues. And the White House has taken on a lot at the moment in terms of what it's trying to achieve, and maybe some people just see this as like you say, it's just too noisy right now.
Yeah, and I mean, it's not that tariffs weren't mentioned on the campaign trail. It just goes to show, this was all out there, but I just don't know how seriously it was taken. Many thought the Trump administration would be good for business. We saw the markets hit record highs in December, so.
Well, they definitely thought it was good for business at the time. They definitely did.
Right. At the time, that's what you expect. And, the Q4 earnings season was part of it started before the U.S. presidential election. And so there was kind of cautionary language used on those calls. But post the election results, there was more of an optimistic view on corporate profit growth. And some sectors, I think specifically of the airlines, came out and said, Delta CEO Ed Bastian, we're expecting the best year of revenues ever in 2025. And so there were these grandiose statements that this is going to be the best ever. And now those airlines have come back and they've guided lower for first quarter. They all issued 8Ks last month. Southwest, American,
Just explain quickly
Delta.
What 8Ks?
Yeah, that's just when you have a company update that might meaningfully change. Something's meaningfully changed the picture, and you need to update investors. And they're not uncommon, but it's not very typical to issue one in between two earnings reports, right? Unless you are trying to prepare folks for, you don't want to shock them.
Bad news.
Right. They've had a month, investors have had a month to digest that. Maybe when they report, it will, not be as much of a shock or won't be as bad as they said in the 8K. So, but yeah, just that industry alone, travel demand has fallen. A lot of that's government travel because all of those, so many federal positions have been hacked. But even leisure, that was something that really benefited out of the COVID-19 pandemic, because people wanted to get out and travel and spend money on experiences. And we're starting to see that cooling as, folks just aren't sure. Will prices go up? Will I have a job? So holding back a little bit there.
The level of uncertainty. I mean, we do have Delta reporting tomorrow, from what I can see, as well. So it's going to be interesting to hear what Delta says now in terms of any guidance they want to bring forward. I want to look at. So we've covered the banks to a degree. Again, there's a whole heap of companies next week, and a mixture. We've got likes of Johnson & Johnson as well as United Airlines. We've got Citigroup. Again, the other banks, Goldman Sachs reports as well. Netflix next week as well. So we're going to. As quite a wide range of companies are going to set to report, but we aren't seeing this. A lot of them are, from what I can see, as services. It's really the goods sector and those companies, manufacturers, that are really going to bear the brunt of what we're seeing at the moment in terms of disruption. What do you see for the goods sector, the resource sector, those sectors that are most at risk or most going to impacted by the tariff war, the tariff battles we've got going on at the moment?
Yeah, I mean, we've heard from a lot of names already on how they plan on implementing or dealing with tariffs, and it runs the gamut from companies that are really able to offset maybe the impact of tariffs. I'm thinking of big box retailers, right? Walmart. They want to price protect because that is who they are, the value retailer, right? They have a better ability to do so because they can negotiate a little better. They can, stockpile ahead of time, and, they do have to pay for the warehouse costs. So that would likely be trickled down to consumers, but they also have 2/3 of their goods in stores are usually domestic, right? So they have less coming from outside the US. But even they have said, it's likely that costs would get passed down, right? So many of these retailers, like direct to consumer names, have been pretty clear that, oh no, when there are tariffs, just like there were in 2018 under the last Trump administration, we pass those costs down onto consumers. The amount depends on, how much the tariffs are and what the phase-in plan is. And the difference this time around is that there doesn't seem to be as prolonged of a phase-in. It seems to be sort of immediate. Okay, these are happening right now. And so you're seeing different retailers talk about strategies for, even some footwear makers like Steve Madden. Will they move production? But the problem there being, where do they move production? Because now we've hit every country with a tariff, right? Yeah. So that was kind of the plan in Q4, how many of them dealt with it. They were looking into moving manufacturing, but it's like there's almost no place to hide at this point. You see,
well, let's look at this. Let's break that down very quickly. So say you're Cambodia, you're in Cambodia, you have a factory or you use a factory over in Cambodia, you're probably paying $6-7 an hour a unit for a product. You want to bring that back to the US. Now let's set aside the cost of real estate and to build, if you haven't already got a pre-existing factory there, the cost to then remachine the current line. You're paying probably $20 an hour for the same unit. So I don't understand where that's going. And then, there was talk of, we'll bring machines in, we'll mechanize everything. Well, then that's not bringing jobs back to the US, is it? It's bringing machinery and
from elsewhere. Yeah.
From elsewhere. So again, there are more questions than answers, and we're aware of that. But ultimately, the market appears ever hopeful. We saw pre-last Wednesday's, it seems like a year ago now.
Liberation Day, yes, last Wednesday. Not even a week ago.
Not even a week. And the markets were, all right, guarded, and they'd come off a bit, but they were still hopeful that we were going to get a decent, statement from the president. And then obviously that sort of spook Wall Street Journal piece, Bloomberg bit, where they sort of 10% baseline as he was speaking, that seemed to give the market another lift. And the market, and yesterday when we were talking about, there was that erroneous sort of market rumor doing the rounds that they were going to see 90-day sort of pause to any implementation, and the market took a hold of that. No substance to it, really. You look at what Hassett said at the time, the trade representative, about it, and it wasn't anything like really what was put up as a headline. And the market took that and ran with it, even when it was known to be erroneous. The market was still bid on it. It just seems, as I said, they seem overly optimistic in my mind to a good outcome for this. And at the moment, it doesn't. I mean, we haven't even seen the ramifications of what the disruption that we've seen so far feed through into hard data. So it's going to be really interesting, I guess, to put it mildly, when we do actually get some cold facts.
Yeah, I mean, they're grasping at straws. Even today, Trump put out on his Truth Social that he had a good talk with South Korea. China's wants to make a deal badly. You had Treasury Secretary Scott Bessent commenting that 70 countries had approached the U.S. for tariff negotiations, and stocks are up today. Right, the Dow's up, almost 1,400 as we speak. So investors want to believe that this is not true, I think, because they don't understand it. Like, this can't be happening, almost is how I'm sort of viewing it. So they're taking any bit of information that's positive and sort of running with it. And like you said, this is just based on the proposals. Nothing's even happened yet, right? So we haven't even seen the impact of tariffs. They haven't even taken place yet. And we don't know if they're going, they've changed. It's like a whipsaw, right? So the proposals have changed so many times. This most recent iteration was kind of the worst case scenario. No one was even expecting no. You had the chart up earlier of the percent tariff by country. No one was expecting that. So it was the worst case scenario, but we haven't seen the impact yet. We're just kind of trying to gauge what would the impact be based on the information that we have now, and that's pretty difficult to do. But as of today, I think markets are now convinced once again, as they have been over, several times over the last couple of months, that this is a negotiating tactic. It's not going to come to fruition, or at least that's the hope, because, what can they do, right?
Yeah.
When you don't understand it, when you have this much uncertainty, you're just kind of operating as best you can with this information.
Okay. So again, we've painted a gloomy kind of view of the world at the moment, and of the US equity markets. But are there any bright spots in the upcoming earnings season that you can see out there for any sector? Are there sectors that be less buffeted? Because I think this is an all-encompassing issue for a lot of companies out there. But are there any sectors that you see as protected a little bit more than others from all the noise?
Yeah, I mean, if you look at like who the winning sectors are, there's a lot of this again is backwards looking, but healthcare to some degree, that's expected to be a leader in the first, for first quarter.
Right.
Tech kind of followed by tech. Tech is a tricky one, right? Obviously, they're right in the thick of things here, but then you look and the base case hasn't changed for many of these names. Like Nvidia, for example, demand for their Blackwell chip is like pretty impressive at this point. I think 3.6 million units have been ordered this year. So the demand is there. The interest in AI is still there, but now there's this uncertainty about how tariffs will impact some of these, Mag 7 names. Apple saying
at what price, isn't it? It's probably obviously the demand's still there, but again, at what price they're going to have to pay if we do get these tariffs implemented, and the costs are going to go up, surely.
Right, and then look today with Apple. I mean, they're talking about looking to India to shift production, which might just be a temporary fix, but they're working to secure an exemption. Apple stores are just being flooded right now. There's this iPhone frenzy as people panic buy. So in the short term, there are some winners. Automobiles, autos.
Yep.
There's been this uptick in, let's purchase your large ticket items now, because they might be, much more expensive in the next 6 months, in the autos, household durables, so appliances, things of that nature. Yeah. It will take a while for the tariffs to kind of filter through. There's obviously a lot in inventory here, and that will be maybe a longer timeline than something like produce, right? Which you would see immediately because there's no shelf life for produce. But some of these larger ticket items, they're seeing a bump now, and perhaps in the short term, and then if there are negotiations, perhaps they can be insulated in the long term as well. But yeah, you're certainly seeing some winners currently as people kind of start to panic buy. And then I think some of the other names, like I mentioned Walmart, like obviously they have the ability to negotiate, to price protect. Yes, they said they're going to basically pull all the levers. This isn't their first rodeo. They dealt with tariffs last time. They did have to increase cost of certain goods in the stores, but they said they always manage it. And because they're a discount retailer, they're already getting not just kind of their target customer, but higher income folks are trading down and shopping at Walmart. So you still need groceries. That's a large part of their business. They're a one-stop shop. You go for groceries, you buy some discretionary items. So names like a Walmart, Costco, we've seen Costco doing really well. The off-price retailers like a TJ Maxx or a Ross Stores, anything that offers consumers value, which they really perceive to, they need that right now. But I think some of those big box names do have the ability to both price protect a little bit and then, lure consumers from, that might not be their typical consumer, get some of those to trade down.
Sure. Okay. It's timely that you said that because we do have obviously US CPI data out later in the week on Thursday, 8:30 Eastern time. So it's going to be quite interesting to see the wider basket of price basket really, and where we go with that, because it was looking a little bit softer, I think, and we were looking a
Yeah.
little bit more likely to see just a small dip in prices, but that may be one of the last two sort of prints we see on the downside if these tariffs do come to fruition, or no, not the tariffs, but the retaliation comes to fruition from a number of countries. But again, looking on the bright side, you said 70 odd countries have come to the table. It's the first stages, and so we can't see anything yet. So I guess in the short term, there's going to be an uplift in economic activity from, like you say, people running down of inventories and everything else. But then there's that stock rebuilding and the price and the prices and the cost of all that down the road to come. So we'll start to wrap it up now. So in terms of the earnings season itself this time round, it's really, like you say, forward looking. We're looking more at what companies have to say about where they position themselves over the next 3 to 6 months at least, to try and I guess protect themselves as best they can from the current disruptions they're seeing. Would that be accurate?
Absolutely. Yeah, we really need to listen in to, get a better idea, get some more color, as much as we can, because again, they're operating in this uncertain environment as well. But it will be pretty telling if we see a lack of guidance, if we see guidance X tariffs because they're not sure how to sort of work that in, and just general, management commentary. Again, there was a very cautious tone in Q4 calls around the tariffs. There wasn't as much clarity on, what would happen with tariffs. Now we have, I guess, some more clarity because we've seen some proposals. So it'll be interesting to hear from different sectors. And like you said, who's protected? I mean, it's like almost every sector has come out, or companies from every sector, and shared ways in which, they will be impacted either directly or indirectly.
Right.
So this is kind of our next read on, U.S. corporate health, the health of the U.S. economy, and hopefully we get some guidance that helps us to figure out where the rest of 2025 might be going. Because a lot of the growth that was expected to come in the first half of the year for U.S. corporations, analysts have moved to the back half of the year.
Right.
After this quarter, they will start to go in and change that guidance accordingly. And so, will they hold it? Will the back half of the year come down? We won't know until we get a large chunk of earnings in.
Yeah, fair enough. Okay, and on that note then, I'd like to thank you, Christine. Anyone who wants to go and find out really what's happening and wants the intel on the earnings season and on the broader equity market moves out there in company corporate world, please visit wallstreethorizon.com and search out the packages they have for investors who want that, again, as I said, that little bit more intel on what's happening there. Obviously, you have Live Squawk if you want to listen in on a daily basis to find out what's happening on earnings season as it's about to hit. We'll have, again, earnings from banks this side of the weekend, and again the beginning of next week and all through next week, as well as some other big firms as well. So visit livesquawk.com for that. Christine, thank you. And this will be going out on, what's the day? The 8th of April. We'll push it out today, and we'll push it again tomorrow morning for anyone who wants to have another listen. So thank you
so much.
No, always a pleasure, and really interesting times that we're in at the moment.
Yes, fingers crossed that it's better than we expect.
Yes, indeed. Thank you again. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.